Good morning, everyone. We'll go ahead and get started. Thank you for joining us and welcome to Outlook 2025. That's the spirit. My name is Matt Jenskow, investment strategist here at Waddell & Associates, and it's my pleasure to kick off today's call. We appreciate you all taking the time out of your busy days and lives to join our session this morning. Our speaker today needs little introduction. David Waddell, our CEO and chief investment strategist, has over 2 decades of experience leading our firm and investment team and appears regularly, not just here, but on CNBC, Bloomberg, Fox Business, Fox, you name it. For those of you joining us for the first time, welcome and thank you. Waddell & Associates is a wealth strategy firm dedicated to enriching life by providing clarity. We serve client families across the nation, providing a wide array of financial planning and investment management strategies. It would be our honor to welcome your family into ours. Feel free to drop your questions in the Q&A area throughout the presentation. David and I will do our best to answer as many as we can at the end. We'll just see how much time we have. If we don't get to your question today, rest assured we'll reach out to you after today's call. We're doing this live, but we are recording this presentation and we'll send out a replay in the next few days. It'll also be made available on our website at www.wealthstrategists.com. And without further ado, please enjoy our Outlook 2025. That's the spirit. David, I'll hand it over to you.
Thank you for clicking in this morning to see our Outlook 2025 presentation. Yes, I realize it's mid-February, but it takes a long time to put a presentation like this together after year end. And in light of that, I do want to put out a couple of special shout outs. Number one, I want to thank you, Lainey Oberg, for managing my office when I go into isolation to do presentations like this. I want to thank you, Matt Jenskow, who did a great job, I think, with that introduction. Also helps me a lot on research, with fact checking, and just a good sparring partner overall. And also Karen Rowe, who ensured that all of the invitations that you received hit your mailbox, I hope, multiple times. And so thank you, Karen, for your efforts to build another record audience for us. And then last but not least, Nicole Bean, who created this deck and somehow turns my thoughts and hundreds of slides into works of art, as you can see before you on the screen. So thank you to each one of them. And now let's get going. Before I begin, I guess I should explain to you what animal spirits are, since they're going to be the subject of our discussion today. Well, Sir John Maynard Keynes, a British economist, may not have coined the term animal spirits. That was done, I think, by a Greek philosopher, just like everything else. But in his 1936 book, The General Theory of Employee Interest and Money, which you've unlikely read, he did use the term for the first time in economics. And what he meant by animal spirits was animal spirits are the instinctual, emotional, and psychological factors that drive economic behavior beyond just rational decision making. And when animal spirits are low, confidence is low, risk-seeking behaviors are low, which means innovation, investment, and economic growth are low. When animal spirits are high, confidence runs high, risk-seeking behaviors run high, which stimulates innovation, investment, and economic growth. And periods of heightened animal spirits have heightened levels of speculative activity, a la Bitcoin. Periods of heightened animal spirits have heightened level of investment and also innovation, a la the Mag 7, all of their capital spending, and the internet, artificial intelligence that it targets. And animal spirits can drive collective confidence to upend the status quo, a la the landslide election of President Donald J. Trump. But as with all highs, there can be lows, and excesses can lead to pain. So the question is for 2025, will the heightened animal spirits in this economy deliver gains or pains for investors over the coming year? That is the question I will endeavor to answer. But before we look forward, as we do, we should always look back, hold ourselves accountable. This time last year, we stood before you and presented our Outlook presentation, Why They Gotta Be So Mean, a swift survey of economics, politics, and markets for 2024. What inspired us for that presentation was that after years of COVID craziness, we really wanted things to simply calm down. While we've been living on the fringes of the bell curve in the COVID era, that ultimately things would revert back to the mean, back to average, and wouldn't that be kind? Well, the most important economic measure in the post-COVID era has been inflation. Let's check in. So at the end of 2023, the Fed's preferred inflation gauge, the PCE Core Index, was running 3% after pre-COVID levels of 2%, post-COVID levels of 6%, clearly returning to the mean. But the Fed really wants this level down at 2%, as they've telegraphed. By the end of 2024, we did decline a little bit more, but overall inflation levels didn't decline nearly as much as people might have expected, coming in at 2.8% by the end of the year from 3% the year before. However, within that core PCE number is a whole lot of housing inflation, which tends to lag. If we remove the housing inflation from the equation, then year-end inflation rates really ended at about 2.3%, which is a much more comfortable level for the Fed. So we expected the Fed funds rate to drop from 5.4%, where it effectively ended 2023, to a lower level in 2024. Basically, Jerome Powell told us that. And what he said was, I think the expectation would be that the real rate is declining as we move forward. What that means is you can expect the federal funds rate to fall faster, actually, than the inflation rate itself, and indeed it did. We ended with a federal funds effective rate of 4.3% at the end of the year, a full percentage point lower than when the year began. And that helped support the economic environment for the US in 2024. We expected GDP to grow above trend at about 2% in 2024, but even more exciting, it grew closer to 3% in 2024, a much more robust economy than us or most forecasters would have anticipated. And when you look at the expectations from Wall Street entering 2024, they were pretty meager. This is a bell curve showing the lowest expectation for the S&P 500 came from JP Morgan at 4,200. The highest expectation came from Ed Yardeni at 5,400. And on average, or at the mean, Wall Street strategists only expected a 2% gain last year, with the S&P ending the year at 4,875. We disagreed. We were far more bullish for the following reasons. First, we know that if you're in an economic year without a recession, then there's an 86% probability that the stock market will be positive. Furthermore, there's a 63% probability that the gains in the stock market will be 10% or greater. That gave us confidence. And one of my favorite charts of all time, while bell curves typically are normal, there is nothing normal about the returns bell curve for the S&P 500. You are far more likely to get a plus 20% up year than you are to get a year between 0 and 10%, certainly a 2% year, which is what the Wall Street analysts expected. So our prediction for 2024 was that analysts were being too pessimistic and that it was going to be a love story. All right, so in markets in 2024, our optimism was proven out. In terms of stock market returns, the Magnificent Seven did return 64% last year, another remarkable year, especially having done pretty much that the year before. And that pulled the S&P 500 up nearly 25%. If you take the Magnificent Seven out, the S&P 493, the rest of the S&P, still went up 12%. The Dow Jones Industrial Average went up about 15%. Mid-cap and small-cap stocks went up about 13, 12%. And then the international stocks lagged a little bit, some of that currency effect, but the emerging markets still were up 7.5%, while developed internationals were up 3.5%. So a great year for stock market investors, but a good year for bond market investors as well. High yield bonds, which tend to correlate more with stock market returns, actually advanced 8.2% last year. The total bond market index was up 1.3%, and then municipals and treasuries produced slight gains too, as interest rates basically climbed higher towards the end of the year. And then finally, people in currency and commodity markets did fine too. Bitcoin was up 121%. Gold, interesting, was up 26% on par with the S&P 500, even with the US dollar 7% stronger. They are typically inversely correlated. And the 7% strength in the dollar led to weakness in the euro, yen, and in the emerging market currencies. So for the markets, 2024 was indeed a love story. The question is, what is driving all of this growth? Well, what can explain it is a whole lot of enthusiasm for what has been a tremendous economic environment. So let's talk a little bit about where we stand. This has been an absolutely roaring economy since the COVID recession. According to the Federal Reserve, the long-term potential growth rate for the US economy is about 1.9%. This chart chronicles quarterly growth rates going all the way back to the COVID recession. And as you can see, other than Q1 of 2021, which was distorted by high inflation levels, we've been running growth rates well above potential for 5 years. In fact, the overall average for those quarterly results is about 3.3%. That is tremendous growth for that time period within the US economy. And looking into 2025, economists have gotten even more optimistic going into the end of 2024. In fact, of the economists surveyed, the top 10 forecast an average of 2.5% growth. The bottom 10 forecast average growth of 1.9%, right at our long-term potential. And none of the economists surveyed actually forecast recession. And if you look at the Bloomberg consensus recession indicator, it's about 15 to 20% as a percentage. And that's one of the lowest levels we've seen on record. So continuing economic growth is foreseen, lack of recession also foreseen. Now, what is driving all of this strength within the US economy? It's the US consumers. Literally, times have never been so good. First, note that US consumers have never been richer than they are today. If you look at household net worths, right before COVID, we had about $120 trillion worth of net worth. Today, our net worth is $170 trillion, which means US households are 42% richer today than they were before the COVID pandemic. And also, US consumers have never been better paid than they are today. Here's a chart of disposable personal income, which is the amount that you can spend after taxes. Before COVID, income was running about $16.5 trillion. Today, we're running at $22 trillion, meaning that incomes are 33% higher than they were before COVID. It's literally the best of times for the US consumer. And because of that, it's allowed them to consume, which powers GDP. This chart shows you the contribution of personal consumption expenditures to GDP going back to the first quarter of 2022. As you can see, the last 4 quarters, which entail all of 2024, end up providing more growth on average than even the potential GDP growth rate itself. So the US consumers are powering GDP. Inflation has also kept consumer sentiment in check. So even though we're seeing record consumption levels, we are not seeing record consumer optimism levels. The reason this is important is because it has kept debt utilization at bay. Right now, US household debt to asset ratios are actually at their lowest levels in 50 years. And debt service levels, even though interest rates have risen on car loans and credit cards and mortgages, et cetera, are still at 30-year lows. And yes, as some of the clients have emailed me, credit card delinquencies have risen. Is that concerning? Well, not particularly, especially when you look at all consumer loans together and the delinquency rates associated. Those are still very well anchored. Also, remember this: those who rely most on credit actually spend the least. This chart segregates income levels into the bottom quintile, second quintile, third quintile, and then I lump the top 2 quintiles together. Consider this kind of the 80-20 rule. The top 2 quintiles by income level actually provide 62% of total consumption. The bottom quartile only provides 9% of consumption. So as default rates spike in the lower quartile, it may create a little bit of a drag, but they don't do a whole lot percentage-wise of the spending anyway. And this will continue as long as there are still jobs to be had. And right now, we still have more job openings than we have seekers. We have 1.1 job openings right now in the United States for each unemployed worker. And yes, monthly job gains have started to slow, but from a very high level post-COVID, really monthly job gains are simply normalizing down to a more reasonable level. So for consumers to continue to be as wealthy as they are, as well paid as they are, as well employed as they are, we need corporations to be just as robust. And indeed, they are, and they're also highly optimistic about the coming year. Big businesses are very bullish. This is data from a survey that was done by JP Morgan of their large business customers and their leadership within. 94% expect revenues or sales to stay the same or grow in 2025. 91% expect profits to stay the same or grow. 84% expect capital expenditures to grow or stay the same, leading the head of commercial banking at JP Morgan, John Simmons, to say business leaders are charging forward with optimistic outlooks and ambitious growth expectations for 2025. And here's what I know about optimistic and ambitious corporations. They're not in the mode of firing people. In fact, when they revealed their headcount plans for 2025, only 8% of those polled indicated that they would be reducing headcount. So it appears that big businesses will continue to retain and hire employees, which is great since they have overall the larger share of employment relative to small businesses. But don't count small businesses out. In fact, small businesses are even more bullish than big businesses. Small businesses, by the way, are typically a pessimistic lot. But 52% of them think that business conditions are going to get a whole lot better in 2025, which is the highest rate we've seen going back to even beyond this chart into the 80s. And so small businesses are highly bullish as we enter the year. And small businesses actually in up years provide the bulk of the new hires. This is also bullish for the jobs market. And then this was my favorite of the sentiment statistics I was able to locate. For those who were very concerned that the collapse in commercial real estate values would create a collapse in community banks, which would create a repeat of the global financial crisis, I am pleased to announce that community banker sentiment has never been better than it is today. So the great financial crisis part 2 clearly hasn't happened, or they're just completely unaware of it. I think what this tells you is that from a community bank perspective, the credit quality of the people they're lending to is very high, and I see that as very bullish from a ground level perspective. And so record profits from corporations really do spread joy, they stoke enthusiasm, they stimulate animal spirits. And if you look at corporate profits after tax going back to, last 25 years, you can see that surge after COVID. How big was that surge? Corporate profits today are 80% higher than they were pre-COVID. And corporate profits as a percentage of US GDP have never been higher than they are today. And profits also seed startups, which fertilize innovation. And since this chart began in 2005, we've seen an uptrend in startup activity that rocketed higher in the post-COVID era to where we're starting somewhere over 5 million new companies per year. And this activity can drive more economic growth, certainly drives more innovation, which ultimately leads to more productivity, more startups, more enthusiasm, obviously a good thing. And just like the consumers, corporate debt levels are actually very low relative to history. So this is non-financial corporate business debt as a percentage of net worth. That's obviously at a very moderate level. And if you look at the interest coverage ratio, which takes the amount of earnings that's covering interest expenses, even with higher interest rate, that ratio is near a record high. So corporations are in very good shape. Now, we're going to take a moment, talk about the government. While the US consumer has record net worth, record income, while US corporations have record net worth and record income, both of which are in fantastic shape, exceptional shape, the US government, on the other hand, has gotten exceptionally fat. Chew on this chart for a minute. This shows government spending as a percentage of US GDP by decade. If you go back and you look at the 1950s, the government was spending on average about 17.5% of GDP, which over a guns and butter period, and then some extra defense spending to win the Cold War from Ronald Reagan, we went up to 22% of GDP. And then once that defense spending started dialing back and Clinton and Gingrich got together, we reduced spending as a percentage of GDP down to 20% in the year 2000. And then from then, it's been nothing but higher. In the 2010s, we averaged near 23% spending as a percentage of GDP. And then this decade so far, we're averaging about 26, 27% government spending as a percentage of GDP. That's a lot. Unfortunately, for our deficits and debt, revenues, even though we see a lot of different tax policy, as a percentage of GDP, don't tend to change all that much. In fact, over the last 75 years or so, accounted for here, tax receipts as a percentage of GDP have averaged about 17.5% on an annual basis. And as you can see, as spending goes up and tax receipt levels basically stay the same despite whatever the prevailing tax regime legislation is, it's created this huge deficit and this huge debt problem for the United States of America. And the government hall monitor for the deficit, the Congressional Budget Office, sees no real relief in sight. We're currently running about 6.5% budget deficit numbers. And as they look forward pre-Trump, they see that number sort of staying the same, if not getting worse. So CBO sees no relief in sight. And big governments make for very busy work. This is interesting. So post-COVID recession, we can see that the growth rate of employment in private industries has come down to a more normal level. But while private industries have been reducing employment growth rates, public industries, a la the government, have actually been increasing their employment growth rate. So governments have been hiring at a higher rate, while private industry has been hiring at a lower rate. And all these people have to do something. And so we've also seen record regulation. The way to tabulate that, the government keeps a book on how to do your business, which is its regulation manual. And in the year 1950, that book had about 10,000 pages in it. At the end of last year, that book had 190,000 pages of regulations to tell people how to do their business. And if you're going to have record regulations, you also kind of need record bureaucrats. This is a fun chart. You can argue with it, but I kind of like it. If you go back over the last, 50 years or so, or back to 1980, I should say, the entire population of the United States has increased about 50%, while the entire population of Washington, D.C. has actually increased 100%. So record regulations, record spending levels also lead to record bureaucrats. But this point is not unknown to US voters who went to the ballot box back November and voted for Donald J. Trump 2.0. And Donald Trump 2.0 has selected as his spirit animal the 25th president, William McKinley. William McKinley was known for very innovative media campaign strategies. He was known for America First tariffs. He was known for very imperialistic, I should say, tendencies with Guam and Puerto Rico and also the Philippines. But he was also known as having a kingmaker rich friend named Mark Hanna, who helped him win the election. Oh, and by the way, he was also shot by an assassin. History may not repeat, but it certainly does rhyme. And McKinley's picture is now hanging next to Trump's desk in the Oval Office. Well, Trump was given some clear mandates coming into his second term. Number one, Donald, please grow the economy. Well, as we've shown you, the economy actually has been growing rather robustly. The most important thing for Donald as he starts his second term is not to shrink the economy. His Tax Cut and Job Relief Act back in 2017 will expire at the end of this coming year. And if it does, that will levy onto the US economy $4 trillion in new taxes. Now, he also campaigned on expanding the size of that act in many ways with a larger child tax credit, removing the cap on the state and local tax deduction, and some other giveaways that could make that an even larger figure. But for our purposes, and for this part of the analysis, let's just assume that it's going to cost $5 trillion over the next 10 years. That's the budget window for reconciliation purposes, or for ease of tracking, call it $500 billion a year. So for Trump to keep the economy just at status quo, he has to take on an additional deficit, according to the CBO, of, call it $500 billion a year to begin. Well, he's also talked about stimulating the economy with corporate tax cuts, cutting taxes from 21% to 15%. Now, the way the US economy is structured, which I'm showing you, or the US government finances are structured, as I'm showing you in this chart, is the vast majority of tax receipts actually come from individuals, either through payroll taxes or directly. So the proportion of tax receipts that's corporate is rather small. But according to the static scoring system of the Congressional Budget Office, if Trump were to cut corporate taxes from 21% to 15%, that would add another $50 billion to the $500 billion in additional annual deficits. But let's take a look at that. So If you go back to Trump 1.0, the corporate tax cut went from 35% to 21% when the Tax Cut and Jobs Act was enacted. Looking at tax receipts since that moment, taxes on corporate profits have actually more than doubled over the last 7 years. So, as Art Laffer taught us, sometimes lower tax rates equal higher tax receipts. That doesn't show up in the CBO budget estimates, but it does show up in the annals of history, just as it has done here. So if Trump cuts the corporate taxes to 15%, which by the way would be the lowest rate in over 100 years, will that create even more tax revenue? I don't know, but we're all for it. See what happens. All right. One place where Trump can stimulate the economy without having budget impact, although you could argue there'd be some budget impact and reduce bureaucrats, but he can cut red tape. So if you go back to the 190,000 page regulatory rule book, that costs U.S. corporations a good deal to comply with. In fact, firms of all sizes spend per employee about $13,000 a year. And as you can tell by the chart, for smaller companies, this is even more punitive at closer to $15,000 a year. That's bad news. But for U.S. manufacturing companies, this number is far larger. So for manufacturing companies in the U.S. with less than 50 employees, the cost to comply with that regulatory morass is about $50,000 a year. Ouch. If you look at it overall, it's about $29,000 a year. And as an employer with a chief compliance officer, who's awesome, by the way, I can attest to the fact that compliance costs are indeed significant. If you look at the annual compliance costs economy-wide, the burden is actually $3 trillion, which is 12% of GDP. So should the Trump administration effectively cut wasteful regulations, which are introduced but never sunsetted, that could create a tremendous stimulus and a great tax increase without necessarily budget impact for the economy this year and going forward. Also, by reducing that burden, that regulatory burden, specifically maybe on antitrust and some of the other things that have been heavy-handed as of late, it could reinvigorate the capital markets, which right now, if you look at capital market liquidity, which is the sum total of IPO activity, high yield bond issuance, leveraged loan issuance, which are used for mergers and acquisitions, that percentage as a percentage of GDP has looked more recessionary as of late than it has expansionary. Although it is started to tick higher, which bodes well for markets. And of course, animal spirits will take that even higher still. All right, Trump had a second mandate. It was somewhat implied, but people are sick of the deficit. They're concerned of the deficit. He needs to shrink the deficit. Well, as I've shown you already, unfortunately, by extending the tax code and by potentially implementing new corporate taxes, at least the way the CBO scores it, Trump's already $550 billion in new deficit spending. And he's had some campaign proposals that can chip away at that. For instance, he will probably reverse some of the policies in the Inflation Reduction Act, also known as the Green New Deal. Maybe that saves $700 billion or call it $70 billion a year. Now our problem is only $480 billion. Maybe he reverses student loan forgiveness as he's talked about doing. Maybe that's $300 billion or $30 billion a year. Now our deficit problem is only $450 billion. Maybe he'll close the Department of Education. I don't know whether he can do that or not. And a lot of that is a flow through for student loan activity. Nonetheless, if he did, the savings might amount to $200 billion or $20 billion on an annual basis, bringing us down to $430 billion in deficit problems. And then you got DOGE. I go to the DOGE tracker, see what's up. So supposedly DOGE has already saved us $55 billion, the vast majority of which is really layoffs. We won't get the benefit of those 75,000 layoffs or voluntary layoffs, I suppose, until September. And I don't know how much the swamp will tolerate his path to try and reduce $1 trillion in spending. So let's just say Doge literally can save us $100 billion, and that amounts to $10 billion in savings over, the 10-year lifespan, which is the window for budget reconciliation. That takes us down to $420 billion. So where are we going to get $400 billion just to keep the deficit neutral? Well, the United States imports $4 trillion worth of goods and services every single year. So let's create the External Revenue Service to go tax the imported goods and services. Well, the tariffs that the United States has held on foreign goods have been declining since, basically the William McKinley tariffs in the 1900s, the Smoot-Hawley tariffs, which exacerbated the Great Depression, and then you can see the duties as a share of all imports have been declining at a steady rate until Donald Trump took tariffs from basically 1% to 2% over his first term, and Biden left him right there. So if we need to generate $400 billion worth of revenue, we just need to apply a 10% additional tariff on the goods we're already tariffing, 12%. Simple as that, plugs the hole, let's move on. But is it that simple? Well, remember, if we're trying to reduce the deficit, all this does is keep it neutral. So the 6.5% deficit that we experience in 2024 would be the same that we would experience in 2025. If you want to reduce the deficit, either Trump would have to greatly reduce defense spending, or he would have to restructure entitlement programs, which he has vowed not to do. And because of that, we expect deficits will continue to remain large. All right, so if we're going to use tariffs to try and plug this deficit problem, we need to dig into them a little bit further and get an understanding of what the consequences would be of tariff regimes. First, we should ask the question, do tariffs cause inflation? Well, we have some experience with this because Trump did increase tariffs during his first term. Looking at the Fed's preferred measure, the Personal Consumption Expenditures Price Index, CORE, in the 2016 to 2018 period, we were running about 1.9% below the Fed's 2% target up until the moment that Trump imposed tariffs. If we look at the rate of inflation after Trump imposed tariffs, it actually declined to 1.6%, which isn't lost on Donald Trump. And if you listen to recent commentary, you'll hear him reference this. However, if we dig in a little deeper, yes, it's true. Personal consumption indice inflation rate did decline over the course of this time period. But if we isolate just those goods, laundry equipment, appliance, furniture, bedding, floor coverings, auto parts, motorcycles, etc., that Trump applied the tariffs to, inflation on those goods actually increased 4%. So yes, tariffs do cause inflation. Second question we need to ask is, do tariffs reduce GDP growth rates? Well, this chart goes back and looks at the total trade volume as a percentage of the GDP in our country going back to 1870s. And there have been many different tariff regimes. We had a rapid period of industrialization that even with some tariffs allowed us to increase trade volumes. And then we got into wars and protectionism. We got into a long period after World War II of trade liberalization. And then after the great financial crisis in 2008, things sort of stabilized into this globalization period, I'll call it. But let's isolate the period between 1970 and today because they were two different regimes. First of all, between 1970 and 2010, trade as a percentage of GDP increased substantially. GDP over that time period on a quarterly basis ran around 3%, very high. And as Ronald Reagan said, if you want more of something, subsidize it. He was a staunch free trader. he introduced a lot of free trade zones, a lot of tariff removals, and obviously we increased trade over his presidency, and GDP went up along with it. Since then, this period I call slowbalization, we've actually been reducing our trade volumes within the economy as a percentage of GDP. You can see the annual changes were negative even in periods without recession. And during that period of time, since 2010, we've been running GDP growth rates about 2.5%. And as Ronald Reagan again told us, if you want less of something, tax it. And indeed we have, and growth has slowed as a result. But there are some who would argue that trade deficits are actually morally irresponsible. Warren Buffett is famous for this argument. And it's true, the United States runs $1 trillion trade deficit. But if that's a morally bad thing, then it has to be a morally good thing to run a trade surplus. The trade surplus countries do have some advantages. Number one, it indicates that they have a very strong export sector, obviously a very good manufacturing sector, and they have international competitiveness. It can lead to a lot of job creation in export-oriented industries, and as they sell goods abroad and import capital or remediate capital, obviously, or remit capital, it obviously creates even higher foreign exchange reserves. These are manufacturing-oriented nations like China, like Russia in the energy pact, and like Germany in the automobile industry. So that's the club of the trade surplus countries. But here's the thing. If you're running a trade deficit, it means you are consuming more than you're producing, and you have to import capital to finance that. So the US runs a mirror image of the trade deficit with a financial surplus. And there are some advantages running a financial surplus. Number one, you attract foreign investment, which boosts economic growth. Also, you can finance domestic investment and development projects. And ultimately, it leads to currency strength as that capital pours in, which makes imports even cheaper. The financial account surplus countries include the United States, the UK, and India. So which would you rather be? Would you rather manufacture toys, or would you rather manufacture high margin investment projects? Would you rather be in the club with China, Russia, and Germany, or would you rather be in the club with the United States, the UK, and India? My preference would be the latter, making me much more tolerant of trade deficits than Donald Trump and also, I guess, Warren Buffett. But nonetheless, Trump is pursuing a tariff agenda. So if we're going to plug the hole with tariffs, it's a 10% increase. What would that do to both the inflation rate and the GDP growth rate as we look into 2025? Well, for this, I relied on work from KKR. They did the best research on this that I found, and I'll skip over some of the details, but essentially what they said is that imposition of a 10% tariff would cost about 0.6% in escalated price levels over 2 years, so 0.6% more inflation. And they also said that it would deduct about 0.4% from GDP. So higher inflation, lower GDP, consequences of increasing tariffs by 10%. And this has been somewhat validated by market movements. US breaking inflation rates have risen since it was clear that Trump was going to win the election. And US interest rates, long-term interest rates, have also risen since it was clear Trump was going to win the election. And this has led to a reduction in the expected number of Fed interest rates this interest rate cuts, this year, down to 1.5 cuts on the year. And it's also led to a substantial increase in the value of the US dollar going into the end of the year. So the markets have already asserted themselves and their opinions on what forthcoming tariffs would end up doing within them. Of course, Trump could just be bluffing. Here's a chart of Southwest border crossings going back over the last 3 presidents. And as you can see, there was a spike higher in the middle of the Trump presidency in early 2019. Trump saw that spike and immediately threatened Mexico with 5% tariffs on imports, escalating all the way up to 25% tariffs on imports if Mexico didn't do something about the border incursions. And as you can see from the chart, they dropped off substantially and the tariffs were never imposed. So, will tariffs be policy? Are tariffs just bluffs? I don't know. It's uncertain, but I do know this: markets don't like uncertainty. This is the movement in the S&P 500 index going back to early 2018 through late 2019. This was a period of tariff speculation within the Donald J. Trump campaign. Markets didn't know which direction he was going to go, and during that entire time period, the S&P only advanced 3.6%, and in fact, it ended 2018 negative after having a substantial correction towards the end of the year. So markets don't like uncertainty. The tariff talk is somewhat uncertain. We've actually been in a trading range in the market since late November. This is something that we've seen from the past and is likely occurring today. All right, mandate number 3, Donald Trump campaigned on reducing inflation. How's he going to do that? Drill, baby, drill. Donald Trump said we're going to put out 3 million more barrels per day of oil, and that's going to drive down gasoline prices, which is going to reduce inflation levels and make people happier. That sounds great, but here's a stat most people don't know. We're already drilling at record levels, and under Biden, the drilling amounts have actually escalated considerably. And by the way, the investment decisions on drilling are controlled by private corporations. And so it might please Trump to see oil levels down at $50, but it's not going to please producers to see oil levels down at $50 a barrel. So even knowing this, the Energy Agency projects that really we won't see that much more oil barrel production a day come online over the next couple of years, making it somewhat unlikely that gas prices at the pump are going to drop substantially. But we create energy in a whole lot of other ways too. We've got nuclear, we've got renewables, we've got natural gas. The only thing we're not using more of is coal, because coal is bad. Actually, in the United States of America, we are running an energy surplus right now, not an energy deficit. And so if we increase energy levels, maybe that presents us the opportunity to do more exporting of liquid natural gas, for instance. Maybe demand from AI will consume a lot more of this energy. But right now, we're actually at an energy surplus. And so we see the chances of inflation rates falling on the back of additional energy production as somewhat unlikely. All right, what about securing our borders? Trump ran on the 4th mandate as well. Well, it's clear why he ran on this mandate. If you look at the illegal border crossings between 2020 and 2024, obviously, you know the numbers, they've gone up substantially. But I would argue that this was actually economic strategy. Remember, GDP is the number of laborers times the total amount of their productivity. So if you have more laborers, it means you have more GDP growth, and you also have lower wage levels, which can help bring down inflation. So I think Biden was doing this deliberately. And here's why. If you look at the growth in the US labor force in the post-COVID era, you can see it's grown a little bit, 5% or so. But if you isolate just the foreign-born workers, their addition to the labor force basically accounts for the entire increase in the labor force overall. So more workers are needed to lower inflation and increase increase GDP. That's why this was done. Trump wants to see this reversed. So I think Trump has a tough hand. And by the way, don't get me wrong, I'm rooting for this guy. But he does have a tough hand. He wants to increase the growth rate of the economy, and yet the growth rate of the economy has already been much higher than potential at 3%. Right now, recession expectations are at a record low. He inherits a deficit of around 6.5, 6.6%, and he has to pass his Tax Cut and Jobs Act extension, to not take that up a tremendous amount, or it will take it up a tremendous amount, and he's got to offset it. We've already got U.S. energy production at a record high, which makes pulling that lever to reduce inflation, I think, kind of difficult. And by the way, housing affordability in the United States of America is at a record low. And if we make the cost of imports more expensive through tariffs and through deportations, we make labor more expensive and less available, that's not really good for housing affordability either. And if you look at the 10-year Treasury yield today compared to where it was when he took office the first time, it's much higher. And if you look at the valuations across assets, specifically the stock market, much higher. And by the way, expectations of investors are at record highs. So I think Donald Trump has a pretty tough hand coming into 2025. However, don't despair, because there is a Trump card. There's a reason why Trump surrounded himself with the Silicon Valley tech bros at the inauguration. That's because the heavy amount of investment spending that they're doing on AI can add enormous lift to productivity in the US economy to help us sustain our high GDP growth levels. And as you can see, they're projected to spend $500 billion or so on AI in 2027, but maybe 2025 as well. And this really is to create more productivity in the US economy. There have been periods of technological breakthrough that have had substantial growth rates and productivity. In the 1960s, we saw the introduction of the IBM mainframe. Productivity levels were 3% plus. 1990s and 2000s, we saw the proliferation of the internet. Productivity levels were 3% plus. We went through periods of, sort of stagflation in the 1970s, not a lot of innovation. 2010s wasn't a ton of innovation. 1980s, there was some with the introduction of the Mac in 1984, but nothing substantial. But yet, if you look at the last 6 quarters, the rollout of artificial intelligence has taken productivity growth rates, back towards that 3% number, more like 2.5%. So let's use that as our baseline for GDP growth expectation as we come into 2025. As we talked about earlier, tariffs could, if imposed at that 10% level, which you can argue will or won't happen depending on your views on Trump's commentaries. But we've seen the projections that could deduct 0.4% from growth. So 2.5 goes to 2.1%. Deportations, if we shrink the labor force, remember labor force times productivity equals GDP. If we shrink the labor force, then we deduct a little bit there as well. So maybe another 0.1%. But with the deregulations, maybe the cut in corporate income taxes, you stoke animal spirits a little bit more. Maybe you get some of that back. And so we do think the economy continues to grow this year at above trend at about 2.2%, which should be good for corporate earnings and good for the markets, which frankly have been purring since the October lows of 2022. So here's what we expect. Well, first of all, retail investors have record return expectations, as I've alluded to, with 56% of those polled thinking markets will be higher 12 months from now. And they're putting their money where their mouth is, as U.S. household ownership of stocks is at the highest level as a percentage of total assets in history. And institutions are feeling the same way, with record low cash levels as a percentage of the stock funds that they manage. And bond markets feel no different, as the amount of interest that bondholders demand on high yield bonds and investment grade bonds are at the lowest levels compared with treasury yields going back 20 years. And if you look within this favored market at the favored Mag 7, the Mag 7's really been in heaven. Going back to the attribution analysis of returns in 2024, Microsoft provided a percent of the return, Apple 2%, Nvidia 5.5%, Amazon 1.5%, Meta 1.3%, Google 1.3%, and Tesla 1%. All the other 496 or 93 companies within the S&P provided the remainder of 11.5%. And we have seen this movie before. Back in the late 90s, if you looked at the percentage of S&P 500 index members outperforming the index, it was below 30%. And that's the situation we find ourselves in today, even more so, where the largest of the S&P 500 stocks are running the most. But that's created some issues. So here's the valuation situation for the Mag 7, who are currently trading at 30 times earnings. And remember, they're 30% of the S&P 500, making the PE ratio within the S&P 500 pretty lofty back to 2021 levels at around 22 times earnings. And in 2025, things will get harder because higher interest rates put pressure on valuations. This chart takes the earnings yield of the S&P 500, which is just the inverted PE ratio, and compares it with the 10-year Treasury yield. And as Treasury yields rise, that puts down force on interest rates. Right now, we are here. So the 10-year interest rate, as per this morning, was 4.5%, which translates into a fair market value PE rate for the S&P of 22. Now, should interest rates go up to 5%, that would take the PE fair value down to 20. That would be a 9% reduction in the value of the S&P 500, which to stay at the same level would need earnings to grow 9%. So the market has gotten very interest rate sensitive, and this is why. For the first time in years, stocks and bonds are actually in a tussle, in a fair fight. Here's another reason why things get harder in 2025. We have much higher earnings expectations. This chart shows the blue line, which is what analysts expected going into a quarter for earnings, and then the yellow dot where earnings actually came in. And as you can see, analysts consistently undershot their earnings expectations all the way through the year 2024. Well, now they've realized that they've undershot, and they've set expectations much higher for earnings going into 2025. And remember, the secret to investment returns is reality minus expectations. When expectations get higher, the opportunity for positive surprises in reality actually gets lower. So this gets a little bit harder. And the other thing that gets harder is where prevailing sentiment levels reside. So as Warren Buffett taught us, we took a shot at him earlier, now we'll applaud him. He said, be greedy when others are fearful. And for those of you who are longtime listeners, you may recall that the 2023 Outlook presentation called The Power of Perspective said that we were very bullish on the market going into 2023 because nobody else was. At that time, only 25% of investors surveyed said they were bullish. And obviously, markets went up substantially. The world did not come to an end. That ended up being a good call. But Warren also taught us to be fearful when others are greedy. At the end of last year, the trailing 12-month bullish percentage was 44%, which is a pretty high level. Historically, when bullish percentage is at that level, the forward returns are positive, but only slightly. So 40% more in bullishness leads to a 4% 12-month forward return, whereas low levels like we had in 2022 of 20% are paired with forward returns of 17%. So high levels of animal spirits don't necessarily portend high levels of return. Unless, of course, it's 1996, which was great. This chart shows the path of a very nice bull market between 1980 and 1995. Now I've mapped over the path of this current bull market from 2010 to now. You can see they're very similar. And then in 1995, that market didn't roll over. It went on to a super bull market over the next 5 years, which would be great. But let's compare the stats from then to the stats now. In 1995, at year end, the S&P stood at 616. 2024 year end, we stand at 58.81. The bullish percentage at the end of 1995 was 43%. As we've seen, at the end of 2024, it was 44%. The next 12-month return, the 1996 return, was 20%. The next 12-month return so far started in 2025. We're already up 4.5%, or 4, I guess, after today, which is positive. But this is where the two differ. The PE ratio in 1995, 12/31/95, was actually 14, whereas the PE ratio today is 22, leaving a lot less upside for multiple expansion. So it's possible that it's 1996, but I'm not sure it's probable. And here's an asterisk to remind you, after animal spirits run at elevated levels, it can take a while to burn them off. So what does Wall Street expect for 2025? Well, the most bullish analyst out there, John Stoltzfus at Oppenheimer, sees us at 7,100 by the end of the year. The most bearish analyst, Peter Berezin at BCA Research, sees us at 4,450. And in fact, he's the only strategist on the street expecting a decline. So on average, the median 660 for the end of the year. So the strategists on Wall Street expect a gain of 12%. As you might have guessed, we'll take the under. You know, bull markets do have patterns that we can review and use to make projections. So bull markets in year one tend to be very robust. The average bull in year one typically goes up 36%. In our current bull, we went up 8%. Bull markets in year two tend to advance 20%. In our current bull, we went up 40%. This counts from the October 12th, 2022 lows, by the way. So year two of the current bull, we were up 20%, which basically took us back down to average, or back up to average rates of return. Year three, the average bull is up 8%, tends to be year of digestion, and we're already up 5%. So we've already captured much of those returns. So maybe we take the year off. But before you get too pessimistic or despondent, I have some things to cheer you up. The annual earnings growth of the Magnificent Seven within the S&P 500 has been magnificent over the trailing years, and thank God, because nobody else really made any money. 2023, the S&P 493 lost 4% in earnings. 2024, they made a little bit of money, not a lot. But as we look forward to 2025 and 2026, earnings will spread beyond the Magnificent Seven, well across the 493. Now, what would cause the Mag 7 to become the Lag 7? Trade frictions might do it. And here's why. If you look at total revenues across the Magnificent Seven, 53% of those sales come from offshore. Compare that to small cap and mid cap US stocks, where 20% to 25% come from offshore. Additionally, the Magnificent Seven stocks are the most recognized companies in the world. So in the middle of a trade fight, you might want to take a shot at Google, Apple, Microsoft, etc., which is exactly what China did when Trump imposed tariffs on them recently, opening an investigation into Google. And so these companies are vulnerable to retaliatory measures coming from overseas. And if you look at the S&P 500 without the overweight to the Mag 7, it's actually reasonably priced. We're currently trading at 16 times earnings versus a historical average of 15.4 times earnings. So beyond the Magnificent Seven, stocks are actually reasonably priced. So here's the winning hand, I think, for 2025. Valuation levels are stretched for US equities, specifically growth equities, whereas ex-developed markets internationally, the valuations are fair. Emerging markets, the valuations are fair. If you look at small caps, the valuations are fair. And if you look at value overall, they're ultimately undervalued. So what's the winning hand? We would overweight small caps, mid caps, value, developed markets, and emerging markets. And for those of you despondent by this call, remember, it's still very early in this game. If you look at the S&P 500 bull markets, there have been 12 of them in the post-war period. Here is their duration, and here is the size of their advance, and here's where you are now. This bull is still very young, and it's still very small. And if you look at bull markets on average, yes, earnings decelerate like I showed you, or excuse me, returns decelerate as I showed you into year 3, but they also tend to accelerate in year 4 and year 5. So do not fold. Here is the bottom line for 2025. We expect that equities will be higher, only moderately so, and less possibly than the street expects. We expect mid caps to outperform large caps as trade frictions end up victimizing the Magnificent Seven. As such, we want to be tilted more towards value, away from growth. We do think Trump's America First agenda does tell you locate more capital within the United States of America. Specifically, as we've seen, his policy proposals tend to strengthen the US dollar. And in terms of interest rates, we think they'll end up being higher for longer as there's more strength within this economy and potentially inflationary threats from tariffs. And as far as bonds are concerned, you can expect 5% coming from the bond market, probably universally to bondholders this year. And the primary threat to our 2025 forecast is that Trump just runs a little bit too fast for the economy and the markets to keep up. I know that we've gone just a little bit over time, but I do want to leave the floor open for a couple of questions. If you don't get your questions answered here and you've submitted them, we will reach out to you specifically and answer those one-on-one. Matt, with that, I will turn the microphone back over to you.
Thank you, David. Insightful as always. We did get a couple of questions. Let's see. There have been early indicators since the inauguration that sentiment business indicators are expressing a fair amount of uncertainty. How would you interpret those early signs for both short-term and long-term forecast of consumer and business spending?
Well, I think that daily sentiment indices and even weekly sentiment indices can be whipped around a little bit, which is why we did a further look back on sentiment using 12-month rolling average. I'm actually encouraged to see sentiment indices come down because I think a little bit of the sentiment froth needs to go away. As far as spending, as long as the job market remains robust, as long as net worths continue to climb, as long as incomes continue to climb, consumption is going to continue to climb. And animal spirits are alive within corporations. Even if you go back to President McKinley, when those tariffs were imposed, the industrialists made a lot of money and they were very supportive and in fact elected him to a second term before he was assassinated. So I think as long as the conditions for consumers and corporations remain positive, those spending levels remain positive. And as a contrarian, I'm encouraged by some of the reduction in sentiment froth, but I'm not sure it's cleared enough to change our forecast.
And another topic of discussion, as you pointed out in Trump's mandates, what do you foresee economic impacts being from the DOGE or the Department of Government Efficiency as potential layoffs, go forward, and its impact potentially on job numbers and the economy in general?
Well, the layoffs, because there's severance, won't really hit the unemployment tape until later this year. So far, at least from the tracker I saw the other day, although I think they removed that number from the tracker, 75,000 people have taken the voluntary, buyouts. So I do think that if you remember the chart where government employment was accelerating while private employment was decelerating as a rate of change, both still positive. I do think that you will have to replace some of the hiring energy from the government. Not only is it not hiring, it's actually reversing field. So that could end up having a drag on the economy. We sort of accounted for that in our expectations, but I believe the amount of lift you're getting from the productivity gains, that's the key to the whole puzzle. That's the trump card. That's everything in 2025. If productivity grows fast enough, then we can handle layoffs, we can handle deportations, and we can handle the imposition of tariffs. So I do believe it creates a slight drag on the economy, but you're not really going to see it in the statistics until later in the year.
We've got time for one more question, and this is a good one. In terms of earnings expectations with the Mag 7 or Lag 7, like you alluded to, any competitors that you're seeing in the space to those companies as we kind of move forward this year?
If we were running just a speculative hedge fund product, then we might be more interested in it because it was priced for dead. Recently, Xi met with the leaders of the Chinese technology companies and said, we really want to see you expressing your talents, which means we're going to get off your back. You guys go run with it. Obviously, the DeepSeek news was of interest because, in theory, they created a whole lot of artificial intelligence capability at a much lower price point, which could disturb all of that CapEx spending in Silicon Valley. So I think competition is good. If China really does come online with marketable technologies around AI, that could undercut the Mag 7 a little bit, but that's to the benefit of the 493, because as the price of artificial intelligence comes down and as the utilization of artificial intelligence proliferates, that just creates more productivity, which is better for all. So I think foreign competition is a threat to the Mag 7, but I think it's a benefit to the economy and stock market overall.
Awesome. Thank you, David. I think that will do it for us today. Thanks again, everyone, for joining us, and appreciate your extended time. If we did not get to your question, please expect to hear from your wealth strategist. And if you don't have one and you'd like to hear from us and have an initial conversation, please send us an email at request@wealthstrategists.com, and we'll get you connected with one. Be sure to subscribe to our weekly emails for regular market and economic updates. Just head over to our website at www.wealthstrategists.com. Sign up today, and feel free to connect with us on your social platform of choice as well. Thanks again.
Yeah, and I will just close by saying this. It is our corporate purpose to enrich lives by providing clarity. I hope that all this work has been able to do that for you this morning. Thank you again for your confidence in our work, and have a great rest of your week. Thank you.